Hi everyone, and welcome back to the Independent Dollar as we close out our January retirement and savings series. If you're joining us for the first time, we make new videos each week on personal finance topics in a way that's straightforward and easy to understand. Today we're going to be showing you a few different ways that you can access money in your locked-in retirement account prior to retirement. Typically, a locked-in retirement account, also referred to as a LIRA, is not accessible until you turn 65, and even then, you're restricted to how much you can take out each year. However, there are a few situations in which you can access your money sooner, and today we're going to explore 5 possible ways that you can do this. First up is unlocking 50%. Once you turn 55, unlocking a LIRA can be a great option. Essentially, unlocking it refers to converting the LIRA into a LIF account. And a LIF is very similar to a RIF, which basically starts to automatically pay you an income every year. Here's where that 50% comes into play though. Within 60 days of converting your account into a LIF, you can then move half of the balance tax-free into an RSP account. Or you can transfer directly into your bank account if you prefer, the latter being fully taxable income. The great part about this option is that it gives you more control over accessing your retirement funds. If you choose to transfer half to your RSP, then that portion can remain there on a tax-deferred basis until you turn 71, but still offers you the flexibility to withdraw from the RSP anytime in any amount that you wish. Now, it's important to look into the regulations specific to your account though. In Alberta, the 50% transfer into an RSP must be done before the LIRA is converted into a LIF. It can't be done afterwards like it is in Ontario. And you also want to factor in income from your LIF. The total amount paid to you each year will be added to your taxable income, and this could impact any income-tested benefits that you're currently receiving. Next is financial hardship. Sometimes we find ourselves in a financial situation that we didn't expect. So there are a few scenarios in this case where you can access funds from your LIRA to help out. And the first is when you have a low income. If you're having a tough year and your income has been reduced, or you find yourself out of work, you might be able to withdraw money from your locked-in RSP if your income is 2/3 or less of YMPE. YMPE stands for Years Maximum Pensionable Earnings, and this dollar amount is set by the Canadian government. For 2020, YMPE is $58,700, which means to qualify this year, your income would need to be below $39,133, and you can apply to withdraw up to $29,350. Just keep in mind that there will be withholding tax, and any amount you withdraw will be added to your taxable income. Depending on your situation, the additional income could impact your income-tested benefits. On top of that, for the following related reasons to financial hardship, you might be able to withdraw money from your locked-in RSP even if your income isn't low. First or last month's rent, arrears of mortgage or rent payments, and medical expenses or required medical renovations to your primary residence. The third way to access money is through small amounts. Depending on the amount of money in your LIRA, you might be able to withdraw or transfer the entire balance of your locked-in account. As of 2020, if you're 55 years of age or older, and the total amount of your LIRA is less than 40% of YMPE, you can apply to either withdraw the funds directly into your bank account or transfer the funds on a tax-free basis into your RSP. This amount does change in each province though. In Alberta, for example, it's 20% of YMPE. Next up is shortened life expectancy. If you're suffering from an illness that has reduced your life expectancy to 2 years or less, then you can apply to withdraw the entire amount from your LIRA, regardless of how much you have in the account. In order to do so along with your application, you will also need to include a letter from your physician confirming this. Finally, you can apply to withdraw money from your locked-in retirement account if you become a non-resident of Canada. If you left Canada 2 years ago or longer and are now a non-resident, you can apply for the entire amount to be withdrawn from your LIRA and deposited into your bank account. Keep in mind though that this is considered fully taxable income in Canada and will be subject to a non-resident withholding tax of 25%. This amount can vary depending on the tax treaty your current country has with Canada, but on top of that, you may owe additional taxes depending on the tax rates where you currently live. This wraps up our last video in our January retirement and savings series. Stay tuned for next week as we start our February tax series on 2020 tips and strategies. Thanks for watching, and we look forward to seeing you back here on Tuesday.